It all began with the collapse of FTX, which triggered a devastating bank run on Silvergate.
Silvergate was one of the first banks to get involved with crypto. Now it says it's voluntarily winding down operations.
Go into your account, take your money out as soon as possible.
Customers have lined up to make sure that they can get their money.
Now cash is relatively attractive.
This was the end of it. Silvergate became a victim of Bitcoin's nature, falling victim to a bank run that I would argue wasn't entirely their fault, but which they could have properly cushioned if they had less duration exposure on the asset side. But this should highlight something that Custodia Bank has been arguing for a long time, that the nature of Bitcoin makes it foolish for banks accepting crypto deposits to lend money. It's not about solvency. It's about being illiquid, which means you're effectively insolvent.
Silvergate shut down its payments network for its digital customers, crypto customers, and now it's shutting down its bank. What's left of this company?
That's a great question. Probably not very much.
Silvergate began as a thrift and loan in San Diego County in the 1980s, but after the subprime crisis, it shifted its focus to residential lending. In 2014, they entered the crypto market by providing bank accounts to companies providing Bitcoin-related services, resulting in the formation of the SEN network. The network, which is available 24 hours a day, allows for seamless payment transfers between Silvergate customers. During the crypto winter of 2018, the company expanded its customer base and hired in-house software engineers to add new features to the platform. The SEN network provided a significant benefit to Silvergate's clients, while also serving as an anchor for their zero-cost deposit base.
They made it very clear that their only relationship with FTX and related entities, including Alameda Research, the hedge fund, was a deposit relationship.
The problem arose following the collapse of FTX. Silvergate faced a significant decrease in digital asset deposits, necessitating a balance sheet restructuring and prudent policies to withstand potential bank runs. The organization took steps to ensure liquidity and accommodate deposit inflows and outflows. Silvergate reduced its workforce by 40%, adjusted its expenses, reviewed its product offerings and customer relationships, and implemented cost-cutting measures. The management of Silvergate believed it had prudent policies in place to ensure the safety and accessibility of its deposits. The management team stated that the balance sheet was designed to withstand a 70% drawdown on deposits and that cash reserves exceeded all remaining deposits. However, on many levels, this was not enough. Silvergate invested a portion of its crypto-related deposits in mortgage-backed securities and bonds issued by state and local governments, the value of which fell as benchmark interest rates rose. Clients rushed to withdraw money when crypto markets crashed in 2022 and exchanges, such as FTX, went bankrupt. Silvergate had to sell securities to cover the withdrawals, incurring a loss of more than $1 billion and hastening its demise.
Silvergate released preliminary results for Q4 in January, saying that it suffered nearly $1 billion in losses over the fourth quarter, but it still had to release a final annual report, its 10Q. And last night it issued a notice saying yesterday it wasn't going to be able to make an extension time to file that 10Q. So this is actually harkens back to sort of signals that have come up in the financial crisis, which is typically when a company can't turn in their 10Q on time, it's a bad sign. And the company went as far as to express general concern over its own ability to operate going forward.
In the midst of all the uproar and scathing remarks directed at the management team, I believe it is critical that we investigate the root causes of this disaster. To begin, the collapse of FTX triggered a devastating bank run on Silvergate, with customers withdrawing a staggering $8.1 billion from the bank. This resulted in a $1 billion loss because the bank was forced to sell assets, including bonds, at a lower price than their marked value on the balance sheet, incurring significant losses and impairing capital. It's not like the bonds held were of poor quality. If they could hold them until maturity, they'd be fine. But this happening in a rising interest rate scenario made them sell before maturity and crystallizing losses. Nonetheless, the company attempted to fight back with decisive actions to mitigate losses and appeared to regain control of the situation for a brief moment. But then came word that the Justice Department was looking into Silvergate and questioning FTX and Alameda transactions on the SEN network. While it is unclear whether Silvergate did anything wrong, the Fed's poking around and asking questions is a headache and distraction that a troubled bank did not need. To make matters worse, political pressure on the bank has reached deafening proportions, destroying what little reputation and trust the bank had left. The pressure became so intense that the Federal Home Loan Bank of San Francisco demanded repayment of the $4.3 billion loan provided when the problems began. This loan recall has already sparked a debate, with some wondering whether it was the result of political pressure and cherry-picking, rather than a neutral regulatory decision. The final nail in the coffin was the bank's delayed annual report, caused by the need to reevaluate the losses incurred and its ability to continue as a going concern. As a result, its clients lost trust in the bank and stopped using its SEN network, effectively killing it. Without its SEN network, the bank's very existence was in jeopardy. The bank went from delaying the annual filing to liquidation in a matter of days.
Its losses are going to be worse than what it said they were going to be in January. And part of that is due to the fact that they had to sell debt securities to pay off for loans they borrowed from the Federal Home Loan Bank. It's also been investigated by, or under investigation by, a number of regulatory agencies. It has alluded to in the notice.
While regulators, politicians, and the macroeconomic environment all played a role in the bank's problems, the management team also played a role. First, they focused the bank's funding on the cryptocurrency industry. In fact, they could have diversified their funding sources or been more conservative in their spending. While it is easy to question their decisions now, we must remember that understanding and managing risk is an important part of their job. They were clearly exposed to interest rate risk. We can now say they held bonds that fell in value as interest rates rose, and they had clients dealing in an asset class that was extremely sensitive to interest rates on the funding side. Their business was also highly rate cycle sensitive, making them vulnerable to market shifts. The most notable issue is that they were paying 0% on deposits and even getting paid to move funds. They could have earned profits by simply holding T-bills, which would have been less profitable but more secure. As previously stated, while the management team made mistakes, the regulators also bear some blame. Regulators have been slow and hesitant to define a proper framework for the cryptocurrency industry, putting banks like Silvergate in an awkward position. Most agencies appear to be more interested in expanding their reach into crypto than in understanding the asset's nature and the proper way to conduct business. They attempt to apply 21st century rules to 21st century phenomena, which is not always effective or appropriate. As a result, it is not surprising that in some cases, litigation is delivering blows to regulators, as their lack of understanding and regulation has led to market confusion and uncertainty.
Do you believe that the potential benefits of crypto are so promising that we should accept weaker anti-money laundering rules and weaker compliance from crypto firms than we require from banks, from brokers, and from Western Union?
Finally, there is some hope that deposits will be repaid in full and that investors will be compensated. However, we must remember that a loss is still a loss, and investors are unlikely to recover the full value of their investments. While the bank's failure may not be as severe as some in the past, there is still the risk of contagion to regional and even large banks. This event may also leave a mark on the industry, as popular on-ramps like Silvergate and Signature are no longer available. I believe the cryptocurrency industry in the United States is hanging by a thread, and most banks are at risk of this bank run.
In terms of cryptocurrencies generally, I can say almost with certainty that they will come to a bad ending.
The Silicon Valley, it was one of the largest banks that failed, and we made a video about it. Please check it out at the end screen of this video, and don't forget to like and subscribe for more crazy finance content.